Thanks so much for joining us today. This is our third webinar since the launch of our report in November. Today, we're going to be talking about investments into alternative ownership enterprise funds. Over the past few months, we've talked a lot about the different models, how they compare. Last time we were talking about how these enterprise models can be a real driver for mitigating the racial wealth gap. But we're really excited to focus on, what does it look like on the investor side? We have a really awesome slate of panelists today. So let's move into some housekeeping items. So this is the webinar format. Unfortunately, we can't all see each other, but please utilize the chat. We'd really love to hear from all of you. You can start out now by sharing your name, organization, where you're calling in from, and then please do keep the conversation going throughout the webinar. If you have any questions for the speakers or just generally that you want to pose, please try to use the Q&A function for that. That helps us keep track of all of it. We're going to have a Q&A at the end where we can lift up some questions, but also throughout the webinar, we can kind of address some of the questions in text. So please go ahead and use that. And then last piece in terms of housekeeping is if you want some closed captions, that is a option that Zoom has. Just hit that CC button. If you can't see any of these, it might be in the 3-dot extra menu items, usually at the right end of your menu bar. So before we launch, I'll just give a quick overview of Transform Finance, because I know some folks here might be your first time engaging with us. We like to say hello to all of our friends, new and old. So we were founded about 10 years ago as a research, education, and implementation partner in the movement to transform finance. So all of our work, it follows the 3 principles that are up on the screen here: community, control, and governance, adding more value than what investors are extracting, and then balancing risks and returns fairly across all stakeholders. So we've really taken these principles and built a whole body of work around this over the past decade. And right now, we are focusing on ownership a lot. It's something that's coming up in lots of different contexts. As many of you have engaged with our alternative ownership enterprise work, which is what we're talking about today, we're really talking about how can enterprise ownership and governance really shift the way the economy is run, and how do we finance that? So doing a lot in this area. Please check out this bit.ly link that we have on the screen, which takes you to our learning hub, where we have a lot of resources. We have ways to stay in touch with us. It's where we're posting all of our new announcements and ways to engage. So check that out. That's my piece. With that, let's get started. And I'm going to hand it off to Julie.
Thanks, Garrett. Hey, everyone. Wonderful to be here. I'm Julie Mentor. I'm a program director at Transform Finance. And I'm going to take the next few minutes to provide some context about alternative ownership enterprises and how they're financed before we jump in to our panel conversation. So first off, what even are alternative ownership enterprises? In conventional companies, owners, and that's typically external investors or a small set of people at a company, have 2 core sets of rights. Those are economic rights, the right to financial benefit, and governance rights. That's basically the right to make decisions about the company. And in contrast, alternative ownership enterprises are firms that significantly shift economic value and decision-making power towards the non-investor stakeholders they impact. So that can be workers, producers, consumers, community members, or even a non-financial purpose. And there are about a dozen types of alternative ownership enterprise corporate structure in the US and the UK. And they really provide a tangible alternative to conventional enterprises by sharing wealth more equitably, being more democratically governed, or being committed to a mission for the long term. So as I mentioned, there's a dozen models of alternative ownership enterprises that you can see here on the screen, and the models encompass a broad range of approaches, and there's really no single best model. It's more about finding the model that best suits the needs of a company. So here at the top, in blue, you'll see some models center benefit to workers. You may have heard of employee ownership, which is another way to describe these models. They range from the worker-owned bakery in your neighborhood to a retailer like Publix, which is owned by employees via an employee stock ownership plan or an ESOP. Other models are focused on preserving a company's purpose. These models include steward ownership models and a few others. That's the green bubble here. And then finally, some models are dedicated to centering other stakeholders, such as suppliers, customers, other people and organizations who don't directly work at the company, but have a direct relationship with it or impacted by its decisions. So that's the orange bubble here. And really what alternative ownership enterprises have in common is that they move investors from the driver's seat to more of a co-pilot position so that a broader set of stakeholders can also influence and financially benefit from the companies that affect their lives. In today's conversation, we'll really focus on models that benefit workers because that's the model where dedicated external financing is most needed at this time. So you'll hear us mention worker cooperatives, ESOPs, which are employee stock ownership plans, and EOTs, which are employee ownership trusts, quite a bit today. And what is the funding landscape for alternative ownership enterprises? Alternative ownership enterprises are financed, can be financed in a number of ways. They can be financed by investors who do a direct deal. They can be acquired by companies that are currently employee owned. They can self-finance. Essentially, they can shift from have the company buy itself out from the owner and become employee owned. Or they can be externally financed by dedicated funds. And that's kind of the focus of today's conversation because funds are the easiest in some ways entry point for investors. And so we conducted an inventory of those funds to help more capital flow in the field. And our research surfaced 47 funds in the US and Canada, which finance alternative ownership enterprises, at least in part. Together, these funds have raised or are aiming to raise close to $4 billion. And that can seem like a big number, and it is significant, but it's still quite small. Just to give you a sense of contrast, venture capital, for example, is deploying about $200 billion a year in the US. So, small but growing, and I think, we think can be considerably bigger and more significant. And so 18 of the 47 funds that we found invest only in alternative ownership enterprises. And those represent about $1 billion in potential financing. And overall, these funds are small. Median fund size is about $50 million. And the funds we identified largely focus on providing debt for employee ownership conversion. So really focus on this benefit to workers segment. A few provide startup capital, some do equity investments, but really it's largely kind of a debt play. And the most common models financed are employee stock ownership plans, ESOPs, and worker cooperatives. EOTs are still rare, but growing in number. And then we're also seeing some interesting innovation where funds are essentially not using an official structure like an ESOP or a co-op, but instead approximating employee ownership by allocating a large option pool and then distributing it in a broad-based way instead of just to senior staff, or building profit sharing for everyone into the DNA of the company. One last thing I'll say is what I think is really interesting about this field is the wide range of fund structures, capital needs, and returns expectations. And that's something we'll definitely explore more deeply today. So in addition to the typical fund structure, which is a general partner with limited partners who put the investment in, there's also a number of other structures. There's evergreen loan funds that are managed by nonprofit entities. There's like the local enterprise assistance fund or project equity. There are dedicated funds that are managed by cooperative conglomerates that are using that fund capital to acquire new companies and grow. So that's an example with evergreen cooperatives or Oberon. There are funds where the investment decisions are made by community members or external experts instead of just the management team, as with the Boston Hajime project. So there's a lot of really interesting things happening, and we're excited to have a lot of folks today here to learn more. And most of all, thrilled really to welcome our panelists today. We have Demetric Duckett, who's a managing partner at Knowles, Humaira Faiz, mission investment officer at the W.K Kellogg Foundation, Thomas Knowles, managing partner at Gratitude Railroad, and Ishita Shah, who is the director of Catalytic Capital at Align Impacts. Welcome, welcome. So glad to have all of you here today. And I'd really, maybe to kick us off, would love to hear from each of you why you chose to invest in an alternative ownership enterprise fund, or and then maybe the terms that you use. I know there's a range of definitions from shared ownership to employee ownership. Yeah, so why did you choose to invest? And tell us a little bit more about the impact that you see in this field. Ishita, do you want to get us started?
Yeah, absolutely. Great to be here, everyone. Really excited for this conversation. And Humaira and Thomas are also just such studs in this space. So at Align Impact, we're 100% focused on impact investing. And we really think about impact across different asset classes and impact areas. I think the entire concept of alternative ownership models is really a core part of what we have been leaning into, with the thought of what does wealth mean for an individual or for a household? And that really centers so much of our work. And breaking it down into the most simplest of terms, what I mean by that is, how can a family not have to worry about a rainy day and savings? How can a family have the access to assets and cash to be able to save up for their retirement? And how can they also help break intergenerational poverty and cycles of not being able to have that wealth created across generations? And when you think about employment is a really big part of being able to have some financial stability in life. But really, we see employment as just one aspect of being able to set a foundation for yourself, but really thinking about not having to worry about the future. We see alternative ownership models as playing a very critical piece in being able to accomplish that.
Yeah, thank you. Who wants to add? Feel free to jump in, or I'm happy to call on you. I know it's a little bit more awkward on video. Maybe Humaira, do you want to add?
Sure. Yeah. Thanks, Julie. Thanks for having me. And I'm so excited to be in this conversation with these panelists, and also Transform Finance. A shout out to just you all for keeping the momentum on shared ownership going. From the Kellogg Foundation's perspective, children, families, and communities are at the heart of everything we do. And we have a deep commitment to racial equity. And so shared ownership models fit really well into that. I have the benefit of leveraging the experience and inspiration of the amazing work of one of my colleagues, Jean Warford, who's a program officer on our systems team, who's been funding research in ownership models for the better part of a decade. And in particularly in employee ownership. So when you talked about naming in terms, Julie, this is the blue bubble in Julie's diagram. The premise of Jean's work is really that the current economic model is not working, especially for employees of color and the communities that they live in. And ownership is an answer to that. And so on our impact investing team, we've been really excited to find investable models that both meet our return thresholds, but are also aligned with this impact of Jean's work. And for me, I think shared ownership really is a great solution for three issues that we've been seeking to solve on the impact investing team. First, how do we create pathways to wealth for the average employee, as Ishita was mentioning, that have few options? Research shows that ownership of appreciable assets is the most reliable and proven way to build multi-generational wealth. Second, how do we transition businesses responsibly to the next generation? We see this come up in our priority places all the time, in Grand Rapids, Michigan to Jackson, Mississippi. How do businesses find financing solutions that transition these businesses while preserving, the quality jobs, the embedment in their communities, that are proud of the product and accountable to the customers, and keen on protecting the ongoing legacy of the businesses? And then third, how do we shift the way the current economic model thinks of and treats employees from really an expense to what we think they are, and what the research proves that they are an integral asset that grow and create resilient businesses and ultimately economies. So with our lens on community and equity at the center of things, I think shared ownership and, in our case, employee ownership are incredibly well aligned as an investable asset class.
Wonderful. Thanks, Humaira. Demetric, what do you want to add to this?
Well, it's a joy to join the conversation. And so everyone knows I'm Demetric Duckett, managing partner at Known for the Living Cities Catalyst family of funds. For those of you who know us at Known, you know that we believe that we are asset management and investment banking evolved. As you know us via Living Cities, you know we believe that all people in U.S. cities should be economically secure, building wealth, and living abundant, dignified, and connected lives. So we ask ourselves a very simple question, which brings us to the conversation today. Like, what does that mean? If you're looking to close racial income and wealth gaps so that people are self-determined, then how do you do it? And I often bring up the simple construct of if train A on white wealth in the US is considered to be at least 225 years ahead of train B on black wealth alone, how fast does train B need to go to catch up? Well, the answer is fast. And so what we believe in our research-oriented approach via Living Cities is that we have to look at the things that go faster. Alternative ownership enterprise constructs, that's one of the ways. There are models we can talk about via our investments that have led to remarkable outcomes for lower income populations. But we also are now exploring via the Living Cities Catalyst Fund 3, a private equity venture capital construct that we believe will help to shift who capital allocators are, so that those who are building businesses at any level, particularly those that are undervalued, underappreciated, underinvested, and underrepresented, are able to get the capital they deserve and need to build abundant lives.
Wonderful. Thank you. Thomas, what about you?
Yeah, so thanks for having me. I think it's important. So Gratitude Railroad, what we're trying to do is really move traditional investors into the impact of investing space. So we work with a lot of individuals and families who are coming from success in, again, the traditional finance and business and entrepreneurial endeavors, and are kind of working off those models and experiences. And then we primarily invest in venture and private equity. So how we got to this space, I think based on that is a little bit interesting, which is really around, I think, three themes. One, we were working within venture and private equity to say, like, how do you change who's accessing capital, who's allocating capital, to try and drive some more shared economic upside with communities that have been left out. And I think that's really important work, and there's so much to be done there. But I think we were feeling limited, or maybe it wasn't moving fast enough. So that was kind of one challenge that started to shine a light on what we were describing as really like alternative financing models. The second is through our investment work in venture and private equity, we were seeing a lot of business owners that were just not interested in traditional venture and private equity for a lot of reasons that are obvious, but mission drift, or what's going to happen to my employees or to my community or to the purpose of my organization. There was just this whole class of business owners who were not looking for traditional venture and private equity. And many of you probably heard of kind of the silver tsunami phenomenon, increasingly aging owners that were looking for liquidity or trying to evolve their business. So there was just kind of this capital gap or type of capital gap for business owners. And I think a lot for our investors too, the venture and private equity model was a little bit limiting in the sense of 10-year lockups, illiquid, a lot of dispersion of returns, a lot of not great outcomes. And if you're trying to drive impact, you want to see these businesses and employees thrive and have long-term employment. So I think there was a desire to see something different. So when we really came into this space, it was a culmination of all three of those seem coming together, where there's an opportunity to drive real wealth creation for employees in underserved communities. This is a great solution for those business owners that were not interested in traditional venture and private equity. And as we talked about, a lot of the structures here are mezzanine debt structures, or structures that create some liquidity, some shorter return timelines. for our investors. And so, it's one of these scenarios where all those things come together and you end up being able to provide something that I think has real meaningful impact, but solves a lot of the challenges in the traditional capital markets and ecosystems that we operate in.
Yeah, wonderful. Thank you. And maybe just to follow up, Thomas, on the topic you were just opening here, and Humaira, you mentioned it, and I know everyone is thinking about this, is there's really a wide range of potential investment returns in this field. There's a role for philanthropy. Humaira, you mentioned you have a colleague on the grant making side also working. So it's really a wide spectrum. I'm curious, maybe Thomas, if you want to start, to tell a little bit about how you think about returns in this space, and part of why we wanted the four of you in this conversation is I think you all think about it quite differently. And so to illustrate that a little bit would be great. Yeah, and Thomas, if you want to just keep going, and then we'll hear from others.
Yeah, sure. I mean, generally, we typically answer this question in different scenarios of kind of like both and, or multiple truths can be true at the same time, which is one, I think fundamentally there's actually a great return opportunity from a commercial competitive standpoint. We touched on some of this, which is a lot of these businesses are not available to traditional private equity and venture capital, which means that they're gaps in the capital markets where if you can access those companies because you're coming to them with a different solution, a different tool, that's differentiated than another private equity fund might be able to come to those companies with. And then two, which we touch on, is the power of employee ownership, diversity of decision making, a broader set of governance and decision makers, and how that creates real long-term value for enterprises. So I think there's very much a opportunity here to be commercial, competitive returns, drive great outcomes with a strategy around alternative ownership. And the other piece is there's no doubt that how we split the pie of economic value creation, that needs to be questioned and interrogated as well in terms of how much of the return set is going to investors versus employees versus communities. And partly what we like about some of the managers that we've looked at is that we're coming in with a debt structure. And again, we need to make sure that the debt structure is not onerous and as aligned as possible, but it creates the opportunity for the equity to be allocated in a different way than just to capital providers. So those are some of the things that we think about in this space.
Yeah, thank you. And Humaira, maybe go next, since you mentioned returns also in your previous comments.
Yeah, agree with everything Thomas said. We see competitive edge, differentiation in creating more successful businesses. Think about the extractive versus additive nature of the different models as we make these investments. For us, both investments one that we've already made and one that we're close to making are out of our mission-related investment portfolio. And in that portfolio, we are absolutely not compromising on returns for impact. Return targets and racial equity stand side by side as mandates for the portfolio. We've invested in traditional GPLP structures, and with both investments, we very much expect them to meet our target returns.
Yeah, thanks. Ishita, what about you? How do you think about this?
Yeah, well, I guess my title is Director of Catalytic Capital, which the Catalytic Capital is by nature thinking about return expectations outside of what might be commercial. But as a firm, we actually look at everything. And so I have a sister team that is also thinking about more competitive returns. And so we try to think of this as like a process of elimination type of a formula where we first think about what types of impact outcomes can be generated through commercial returns. And we really see a lot of ESOP and EOT models being able to fit into that space. And there's market infrastructure built out for that. And then we reserve Catalytic Capital for what are the impact outcomes that can't be generated through commercial returns or require some sort of atypical or non-standard financial features in order to do that. We work very closely with quite a few CDFIs that have been in existence for decades now that work on helping launch and expand cooperatives. Cooperatives are more complex than ESOPs and EOTs are, and require a lot more non-financial support and technical assistance to really help them get up to speed. And so we end up seeing that for structures like that, or even structured equity with capped returns, that requires lower returns. And then there's, of course, a lot of space for grant dollars to make a really big dent in building out the market infrastructure, helping support both funds and also enterprises be able to implement and succeed their models.
Yeah, thank you. Demetric, what about you?
There's so much to say. I so appreciate all the comments of my fellow panelists. One thing I'd like to start with is this notion that we get pulled into this space called impact investing. And what I'd like to share with folks is the notion of all investments having impact. I grew up in global corporate banking in the 90s, Fortune 50, blah, 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 all that stuff. And so we only principally looked at the commercial or public return of our investments. And then we dealt with all the other implications later if they showed up. So what I love about the space is that we're actually encouraging people to own all of the returns that come with an investment. So there are the public and commercial returns. And for our prior investments, we've certainly beat our cost of funds in this space. But there are other constructs we're holding now. Like what happens when you're writing checks and you realize, wait a minute, I write this check and then this whole community shifts, or all these families shift, or all these other things happen. That's not captured in the public return. It's the intrinsic return. So what I love is that we're holding it from a different angle now. And given the fact that I came out of classic corporate banking, we did not consider the things that those of us on the phone call or on the video now are holding as a possible return. That's climate, is individual outcomes, all of the other things. So I just want to encourage us to keep holding that as we have discussions on returns. Yes, we've met the commercial returns. There's so much more that should be considered when we look at those commercial returns that don't consider all of the other impacts, and we add in lawsuits, we add in other constructs, then all of a sudden, maybe that's not quite what we thought it would be. So again, I encourage us to hold that.
Oh, I love that. Yes, yes. It's not like others aren't doing impact investing. They're just not owning that impact. And maybe this actually, you all are doing so great at like helping to shift the conversation forward, because the next thing I wanted to ask is, we have a lot of folks on the video, including folks who are investors or thinking about mobilizing capital to funds, and would love to hear maybe one piece of advice. Obviously, we don't, have all the time in the world. So maybe, one piece of advice you have for folks who are starting their journey and looking at funds and thinking about mobilizing capital, from your experience, what's one thing you would share in addition to like own all of your impact? Maybe Demetric, if you want to kick us off.
I'm glad to do so. There's a very simple construct that shows up in investments and the like, and it's this notion of risk. What is risk? What is it really? I really value using this little story. When you're 3 and you go to the ocean for the first time, it's incredibly daunting. The waves are scary. The depth of the water, the darkness, all of these things are overwhelming. But what happens in life is that you keep going back. And certainly by the time you're 30, you go to the ocean, you jump right in. The ocean does not change. You do. So when you think about risk, even in investments, I encourage people to approach it this way, even with alternative ownership enterprise structures. Familiarity, exposure breeds familiarity. Familiarity breeds comfort. And when you find comfort through those other phases, you're able to reassess what you think risk actually is. And so that's how I approach our work and encourage my team and colleagues to approach it with me, so that we're reducing this notion of that's risky. If you don't know any people of color and you're a white male or white female, and you don't know any other like female investors, if you're a male investor, like if you don't know, you don't know. It's like food. I remember my first sushi bite, right? But now I take it for granted. So my encouragement is, as we look at our efforts in the space, even those of us who have great intention, how are we actually shifting our exposure into familiarity, into comfort, so that we're truly grounding ourselves in the greatest notion of what equity looks like in terms of access.
Yeah, thank you. Oh, I love that metaphor too, because I love the ocean. Makes me very happy. Thomas, what about you? What's some advice you would give to folks who are curious about this space and thinking about mobilizing capital?
Yeah, I'm definitely building on the risk notion. I mean, I think there's I don't know, probably impact investors and maybe Americans as well. We think we invent a lot of things, and I think the reality is this has been done in Europe and in other countries for decades and much longer than that. And there's a lot of actually great data and proof points on the value here, and how it can play out and how it can be done well. So I think there's maybe this notion that feels very new. It felt very new to me, very complicated and kind of overwhelming. But there is a path here to understand it and comprehend it, and folks have been working on it for a while. So I think there's a bit more base of experience than maybe it seems for folks that are coming in. And then two, I think ultimately, as I mentioned before, there's a real opportunity to get exposure to some great entrepreneurs and companies where there's not really another channel to do so. And I think that's beneficial for investors, and especially if you can start to address how wealth is transferred to underserved communities, and thinking about who's benefiting from the ownership from an employee standpoint. There's really not another tool that we've seen that does it in a commercial fashion the way that this structure can. So I think those would be the two things I'd want to just imprint on folks.
Yeah, thank you so much. Humaira, what about you?
Yeah, Julie, you mentioned 47 funds, $4 billion. I totally agree with what Demetric and Thomas are saying about risk, but focusing on the opportunity, I just want to reiterate that it really does feel like an inflection point in shared ownership, and there's an incredible amount of innovation happening across ownership models. There's experimentation in different sectors and stages and geographic regions, and I see many of my peers on this call that are on this journey with us. But for every investment we've made, I think there's 5 others that we wish we could have made. And I think everyone who understands the space, as soon as I at least had this aha moment of, this is amazing, why don't more people do this? And I think the answer, at least in the United States, unfortunately, is more people don't do this because more people don't do this. This is a path less trodden. And the only way to smooth it out is to have more people, or in our case, more aligned impact fund managers, walk down the path. And that's the role of impact investors, I think, is really to help streamline the infrastructure and frameworks to make shared ownership models more mainstream, because they have such incredible potential for transforming our economy.
Yeah, thank you. Ishita, what about you?
I think
What
that
advice?
the practical side of me thinks, okay, for every investor who has not done this before, try to just choose one investment to start with. And if that means that you want to support something very innovative that hasn't been done before, Transform Finance has a list and has the different options of what is innovative and unique and has not been tried before to really pilot something new. And on the other side of the spectrum, if you are an investor that wants to support something that is a proven model, there's CDFIs, some of which are on this webinar right now. I see Shared Capital and CFNE, Cooperative Fund of Northeast, both on this webinar. And these are CDFIs that have existed for 20 to 40 years and have really proven out their track record with their ability to help not just cooperative models, but specifically cooperative models in low income areas and for people of color and for women.
Yeah, thank you. And it circles nicely to Demetric's ocean metaphor. It's just put a foot in and you'll be more familiar.
And Julie, if I could just
go ahead.
interject.
Please.
I really believe, I came from private sector into the nonprofit sector and brought, of course, my experience with me. I grew up in the 60s and 70s in the South with active experience. So I went into private sector with another activist lens. I really believe that it's important for those of us who live in the nonprofit and philanthropic sector to push the notions that push understanding. It's so easy for us to write, loans out of our PRI pools as nonprofits that mirror the greater financial world. That's not progress, in my opinion. So we should be the ones. I mean, think about it. Our money comes from the 5% giveaway in general. And the idea of the giveaway is that we're pushing forward. So we should be the ones that are actually willing to stand on the thinner ice and prove that it can hold us. So that's something I want us to hold on to as we talk about this, not just here, but beyond. We are the ones who are supposed to push forward. I'm proud of my team at Living Cities, not trying to over promote, but the reality is we were in our first funds the ones that helped prove that CDFIs deserve PRIs. That didn't happen 20 years ago. Our second fund, we helped prove out that pay for success and social impact bonds was the thing that could be beneficial. Now our first investments, ooh, a little scary, but by the time we got to 5, other people were moving beyond us. And so now we're on to this notion of greater inclusion, venture, private equity, wealth models, so forth and so on. So for those of us who live in this space, particularly when we're funded by philanthropic dollars, if we're not standing out as activists in shifting capital models, we're probably doing ourselves and the world and the communities we purport to serve a great disservice.
Yeah, thanks for adding that. I really appreciate it. And I guess maybe kind of a final question before we go to Q&A. I feel like we've touched really nicely on like the case for why and how to get started. And I think it would be good to take a minute to also share kind of what are some of the obstacles that you see, kind of why this is, it's different. We've touched on risk, but what are other dimensions or other things to touch on that we may not have touched on yet of obstacles essentially that one needs to overcome, investors have to get over, or the field has to overcome to really grow and kind of capture this inflection point? As you said, Humaira, we're on this, we're at a really interesting potential point of inflection, but how do we make sure we really transform there? And whoever wants to start, just jump in.
Yeah, happy to start because I think we didn't touch on it before. The complexity of the transaction is definitely a challenge. If you just think about from a business owner, they need to get educated and understand it and champion it as, hey, we want to go through this process. Then they need to educate their employees and what it means in terms of a shift in their role and responsibility and hopefully outcomes. And then the entire capital stack from understanding, commercial lenders, because you do need senior debt and a commercial lender to be involved, the mezzanine financing, and then whoever's holding the equity tranche. And so it's definitely a complicated transaction. I think it's something that a lot of the managers in the space are understanding is the timeline from sourcing an opportunity to completion and the amount of work that needs to go into that. So I think the more that we can support organizations that are putting out education and trying to streamline that process, I think is really helpful. And there's a lot of intermediaries around, legal and tax and audit that are helping. So I think that just streamlining the complexity of the transaction is definitely a limitation to just the pace and getting these things done to have more proof points and more comfort in the marketplace. So for business owners that are interested, I'd say, get ready for a challenging environment, but I think it's one that there's more and more solutions out there, and commit to the process for sure.
Yeah, go ahead, Humaira.
Go ahead, Ishita. I'll let you go.
I was going to echo what Thomas said, and the complexity also exists on the enterprise level as well. So the complexity is also about like how the deal will be exited, not just structured, but what the exit pathway is, and what does implementation look like exactly, and what sort of non-financial support do the enterprises require in order to be able to actually meet the goals of shifting ownership to their employees, and also making sure that the employees that they're targeting are not just like leadership teams of the organizations, but also the more like junior level staff and really the full team, and having the impact be like very locked into those models when funds are looking to invest. But overall, the silver tsunami that Thomas mentioned earlier, that is really like such a big opportunity. And the more like education and awareness there is across all levels, the more assets can be allocated towards alternative ownership models.
Yeah, I'll add, I've been feeling a need and maybe an imperative to create a shared impact framework in this sector. I think our first investment in APIS and Heritage is a fantastic example of a fund that really centers impact and equity well. But I think we need a lot more models and a lot more voices in that conversations. You know, what are the standards that we can all agree to on what counts as enough equity for it to be employee owned? What are the pathways for preserving employee ownership at exit? Or what are the different models for elevating worker voice in decision making? So this is something I've been thinking about a lot. And, you know, how do we ensure that models maintain integrity and don't get diluted? Or maybe put in a more positive way, how do we create a shared framework for shared ownership models that actually center employees and communities and the benefits across, so that we create more resilient and healthy economies?
Thank you. Demetric, what about you? How do you think about obstacles?
Well, I thumbs up all the comments. So much about wealth, growth, and support is about lenses and we believe people should have. So for those of us who've lived through various models within our legal and financial structures, we should be willing to demystify. So when we look at the silver tsunami, and we know that so many of those business owners, not unlike my father, God rest his soul, who was in the Second World War, would be well into his late 90s now. And if he had that, I'd actually be a construction company owner now. But the idea being, how do we help even those business owners pull back and reset and remember all the things that allowed them to build their business that came from external sources, not from themselves? And so as they move on, as they think about what's happening in their legacy, what preserves their efforts, and they look at the employees who helped them build that, how do they contemplate giving that opportunity for growth and wealth back to those same people who helped them get there? So part of the obstacle in the space is around convincing people, goes back to lenses, right? Perceptions, getting people to understand how to pull back from what they've historically known and understand what they've historically benefited from so that they can actually pay it forward. And then the rest of us are there, right, to help provide the structure, the finance, the demystification, even for those underlying folks who don't know what the ownership model means. And one of our investments in Project Equity, there was a fast food company that was a localized thing regionally. They did a transfer. I think there were a few dozen, maybe close to 50 employees. And in their first year of distribution, it was almost $500,000. Imagine if you work in a fast food company and all of a sudden you get like a $10,000 bonus. You're like, what? What do I do with this? So there's so many like layers that we can all join in on. So I encourage us to be in the chorus, sing on key, sing the song the way you can sing it, and let's all contribute. But let's make sure we're bringing people along mentally as well as financially.
Yeah. Thank you all. It was wonderful. And I'm seeing a lot of questions in the Q&A and a lot of wonderful comments in the chat as well. And, you know, please keep it going. I think there's a lot of other resources also, you know, as always, you know, we happen to be on the virtual stage, but there's a ton of experts also in the room. So thank you everyone for contributing. Maybe to kick us off, this is a topic we haven't really covered yet, and you know, may not be your deep expertise, but given there's a lot of interest there, someone is asking, I'm curious about where policy intersects with this work, and kind of, you know, what kind of policy analysis might be needed. So your jobs as investors and not policy experts, but obviously there's a really important connection point here. So does anyone want to comment on that and that connection point?
I can start off to just reiterate that certainly not a policy expert, but there is an absolute integral role for policy to play. I think models like ESOPs have gotten the traction they have because of the tax advantages and benefits that they've provided. There are lots of other interesting models that could also come to the forefront with policy support. And there's other, ways of providing funding at the federal and state level that could be really beneficial to these.
Yeah, I
else
see
wanna
the
weigh?
policy
Go ahead, thanks.
conversation. Oh, sorry, Ju. I see the policy following on with such wonderful comments. I see the policy space as one that certain nonprofits who are not in the business of lending and providing financial resources to businesses can certainly take on. How do you fund, roundtables, conversations, the same kind of thing that led to opportunity zones, regardless of what you think about them, it actually happened. The same thing that got us even the CDFIs like 1,000 years ago, or through the low-income housing tax credit construct, the new markets tax credit. If you really believe in the space, you don't have to be a lender or financier, but you can be someone who supports the conversations that lead to the best policy constructs for the outcomes we collectively seek.
Yeah, wonderful. Thank you so much. And it looks like we're getting some, experts in the room also weighing in. So, thanks, Michael. Thanks, Allison. And other points there. It's a really important time. There's a lot of opportunity for sure. Moving to a different question. Arda is asking about kind of blended finance, catalytic instruments, and maybe Ishita, you can start on this. Are there types of catalytic capital that you see in kind of other areas of impact investing that would make sense to exist here? What are kind of new tools that might help unlock more capital? Is there anything that you wish existed here?
Demetric touched on pay for success models that we've seen in a lot of other sectors, especially like healthcare and education. And that definitely there's definitely like opportunity with pay for success models and impact bonds with ownership as well. And then I think in terms of thinking about like a capital stack, really like what already exists in the ownership space and what we've seen in other areas is first loss capital that really helps de-risk, especially new and innovative models that potentially like haven't been completely proven out yet. And so within a capital stack, having some sort of a grant or equity layer that is really absorbing the downside risks and really unlocks larger, more institutional investors to come in that might not otherwise be investing into those models.
Yeah, I was going to mention similar. I think the other thing that's interesting that I think most folks are seeing is in these transactions, the sellers actually are being pretty catalytic in terms of the cost of their seller financing or the amount of seller financing they're willing to do in these types of transactions, because their goal is to have this legacy or wealth creation for their community or their employees. So that's actually a real benefit to other participants in the capital stack, is you're seeing a much higher percentage of seller finance at a much lower rate. So that's kind of interesting. And then I think this equity tranche or first loss is definitely an opportunity for folks that want to see the space grow to help catalyze more, because the senior lenders, the commercial lenders are getting up to speed on this space, but it's also, that's a little bit challenging. There's not a lot of debt providers, senior lenders right now. They're proactively looking for this. So if you can reduce some of that need with ideally first loss or lower cost debt, that would be really helpful.
Yeah, wonderful. That's super helpful. And I think it touches on a question that Dan Fireside is asking, which is, how do we bring down the cost of capital for the impact enterprise? He says it seems unrealistic to demand that these impact enterprises internalize the negative externalities and provide benefit to workers and throw off the same profits as conventional capitalist enterprises. And I think you've touched on pieces of this. I think, Thomas, you were talking about how it's like access to a different kind of company. And so that's kind of a benefit for investors, but curious how you all square that a little bit. And it's kind of a, really strong working tension, I think, in this field. And different folks, I think, end up in different places around it. So there's no kind of one true answer, and I saw some chatter in the chat about this also. So just want to give you all a chance to think, to address a little bit how you think about that.
I'm happy to jump in. I will sort of go back to the reference on Pay for Success. When we first, endeavored to support Pay for Success in the US, it was brand new. And our first investment looked crazy. Our fifth investment made a lot more sense. But even the first investment didn't look crazy at the time. It was the height of thought, the height of all intellect. And, it was brilliant for the moment. And over time, we learned. So I believe that as we look at structures in this space, given that the way we're approaching it is relatively nascent, right? That we have to remember what it means for those of us in the CDFI, philanthropic, nonprofit space to provide the appropriate capital stack for the learning that gets us to the most ideal model. And so that's important. That was important in Pay for Success. Is important now. When we invested in this space, primarily our first investment with Project Equity, this was not a big deal. I grew up in the ESOP world of the 90s, so I know that old school world, right? So when I saw this here in modern terms, I was like, wow, to bring it down to like the real people, not this broad construct that has extractive constructs for those who sit on top, is brilliant. But we have to be willing in this space of impact, philanthropy, CDFI, whatever you consider yourself to be in this world of access and wealth creation, we have to be willing to stand so that it can be built. And it kind of goes back to Thomas's constructs on like capital stack and like who's willing to do first loss. I think a few other people like Ishita, you mentioned it, I heard it all over. Who's willing to write those checks? And we have to be willing to ask people to write those checks if we're standing at a different sort of level of the capital stack. So I think that that's critically important.
Thank you. Who wants to add?
So I think there is folks that are working. So there are like traditional private equity firms that are taking the approach of saying, by having more employee ownership and a different governance structure, you're actually going to create more economic value out of these businesses, and there's no financial trade-off. And there's a lot of case studies and work. And so I would just I think it's important to know that school of thought's out there and for folks to dig into it. I think the other piece is saying, where is the value creation going? And one of the things that we've a little bit struggled with in this space is, first, we've said we're going to come in through a debt structure because I think that, for a lot of reasons, makes the most sense. But as we think about the structure of that debt, I used the term mezzanine debt before, which it is mezzanine debt, but it's different in the traditional form in a lot of ways because there's limited to no warrant coverage. The rates on the debt are potentially seen as lower than traditional mezzanine debt, and the argument that we continue to come back to, which is this kind of real risk versus perceived risk, which is that the quality of the company is very high, and given the structure and the buy-in of all the stakeholders around this transaction, the repayment risk is very low. So I think there's even within the way that we've approached it, and this happens often, is we have to kind of redefine, to Demetric's point, how people are perceiving risk to get comfortable with a rate of return when they might be used to some other view of a rate of return that has a lot more risk involved in it. But I think it's important to know that there's kind of a whole spectrum of how people are approaching this and saying, we're going to create a bigger pie, and therefore we don't have to think about sharing it differently. And then there's a different post there saying, no, we absolutely need to be thinking about sharing it differently. And it's just good to know that there's multiple approaches. So people should be looking at the space, knowing that you can go in different directions.
Yeah, I mean, Ishita, I feel like you're, in the world of catalytic capital, so you're definitely in the kind of the share it differently, share the pie differently. But anything else you want to add in terms of, that question that Dan was asking?
Yeah, one way we think about it also is like there are some models that are for like overall employees with maybe like no specific target to say like low income populations or people of color or women. And I think when we really look at like the end customer and the end beneficiary as what would be the most equitable in terms of how the financial returns are either capped or how the financial returns are distributed across not just investors, but also other stakeholders. And so, what Demetric was saying earlier about acceleration and requiring that acceleration, when we think about like reparations, so people who are low income, people of color, women, when we think about reparations, we really do prioritize more low cost, flexible, and patient capital. And then when we're thinking about just overall employees that don't maybe have any specific target, I think that's really where we are a little bit more like lenient, I would say, with how that financial return is distributed.
Yeah, thank you. Humaira, anything you want to add with the last minute we have?
Yeah, we have the full toolkit. So we make grants, we have program-related investments, and we have mission-related investments. On the MRI side, where we've made investments in the space, we're on one very end of the market. And here, I think the market is working in that these options have to be competitive against traditional financing options that a seller has. And so the traditional financing options with traditional terms. So, they're competitive in the space. What we have to make sure we do is prioritize the impact, the equal distribution, the governance, the frameworks of impact that we talked about earlier here. But I think the long-term value creation of the business, the research shows that that's the case, and that ultimately balances out with the short-term financing challenges as well. But I think I don't think we're ready to, commit to a model here. This is the time for experimentation and really supporting lots of different options.
Yeah, the time for experimentation, the time to, try one thing, get your toe in the ocean, and experiment. I love that. Thank you all so much. I'm going to hand it back to Kurt just to close us out. But yeah, thank you so much. It's delightful to be able to get into the meat of this and to answer some questions from folks. Kurt.
Yeah, wow. Thank you. Wow. Such a productive conversation, so much juicy stuff. There's never enough time. I'm wondering, like, should we do 90 minutes for these webinars? You can let us know if you would spend more time hanging out with us. But I just want to flag also, there's a lot of really good questions in the chat we were not able to get to, like on questions on the business side, relationship with unions, how we can compete with private equity here. There's a lot of stuff that we are digging into and are going to keep sharing with you all. So please stay in touch with us. Here on the screen, you'll see we have a bit.ly link for our Learning Hub where you can sign up for all of the updates that we are going to be putting out over the next several months and future conversations. So definitely stay in touch. What's next for us? We're going to be hosting some more conversations down the line. But right now, I definitely encourage investors, especially, to check out the database of funds that we launched recently that has an overview of all the different funds that are investing in AOEs. It's a really great place to start. Or if you're just curious in terms of who's doing this work, who to get in touch with to learn more about, the actual nuts and bolts, it's an open resource. So feel free to take a look. And please, if there are edits or new funds that you want to add, reach out to us and we can do that. And last thing I want to mention is we're doing some exciting behind the scenes work on new project areas. We're developing some investment opportunities in the space with products and vehicles that we're exploring the creation of. So please stay tuned for some exciting new areas in this world of alternative ownership enterprises from Transform Finance. And so with that, I just want to say thanks again to our panelists. You guys are really, really, leading the way. We really appreciate all the insights that you're able to share with all of us. Let's continue to be partners on this journey. Thanks, everyone. Have a great day.
Thank you so much.
Thank you.